Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. What's going on with me? I'm wearing a tie. We're obviously not in the podcast studio. Thought we would come to you today sort of live on site from one of the dinner presentations that we do so frequently on the road for RFG Advisory's advisors and clients. Hopefully if one of those is stopping by a city near you, you guys can come out and see us kind of live, the live action version of Rick. But in any event, we appreciate you tuning in to this particular market update. S&P 500 right at about 4940, up about 4.5% year to date. Kind of hovering around that range now for the past couple of days. Been a little stable for the past couple of trading sessions. And that's really driven by two things that are out there. The first is it's earnings season. And we're in the middle of it. Roughly 250 companies in the S&P 500 have reported, so right at halfway. And those earnings are coming down basically right down the center of the fairway. Net income per share up about 4.1% year over year. Revenues up about 3.5% versus expectations of plus 2% and plus 3%. That's a little better than expectations, but that's really more in line. In any given earnings season, about 60 to 70% of companies normally beat expectations. So having earnings come in a little bit better than expected is actually expected. So the good news from a market stability standpoint is earnings are coming in and they seem to be roughly in line with where they thought they were going to be. Second thing driving the market is really Fed speak. So the Fed came out with their interest rate decision last week, and Powell was out over the weekend making rounds on the major news shows, really talking about that sort of inflation data, inflation expectations, employment data, and really pushing back on this notion of a rate cut anytime soon as far as the Fed is concerned. When we came into the year, everybody was looking at March and saying, hey, maybe we get a rate cut by March. Powell coming out pretty clearly over the weekend and pushing back on that expectation and saying, no, probably not March. Maybe we'll look to May. It may even be further than that. And a lot of that is because the economic data that we continue to see in in January has been a lot better than what people expected. We got payroll data out on Friday that was a lot better than expectations in terms of number of jobs added. Unemployment rate still coming in at that 3.7% level. We've been there for a little while now. Net job adds a little bit better than expected, and really an upward surprise on the hourly earnings number, all of which kind of paints a picture for the Fed of, hey, job market's still doing just fine, not really, flashing that warning signal that they would want to see or maybe feel like they maybe would be the impetus for them to start to lower rates and start to re-stimulate the economy. So much as Yogi Berra used to say, it ain't over till it's over, we don't know when the Fed will actually start to lower rates this cycle. They don't know either. They're going to wait and see, be data dependent on that. And in the meantime, this notion in January that the economy, that employment rates were maybe a little strong, it's actually not a bad thing in the grand scheme of things. If you think about the opposite, we'd hate to be in a position where Powell is saying, yep, we need to cut rates because it certainly looks like things are starting to really cool off out there. In the grand scheme of things, pushing out that first interest rate cut is not the worst thing in the world. So with that, as always, if you have any questions, please feel free to reach out to myself or your advisor. I hope you're having a great day, and I look forward to talking to you again soon.